balance sheet. So the workings for this one, step 1, prepare a statement of capital, so your goodwill. So to start your question, for type A, you'll be given that you purchased the business for a certain amount of money, and it'll give you a list of the following assets and liabilities that you have. So you make a list of your assets, you make a list of your liabilities, you take them away from each other, and the difference will be your goodwill. So in this question, we've got our assets of premises, 174,000, we've got stock, 14,300, we've got debtors, 14,000, we've got 3 months insurance prepaid, 430. It's just going to make a list of each one of those 4 and add them up. Then your liabilities are going to be made up of your trade creditors of 17,200 and your wages due of 1,200. So just add those 2 up, and that's going to give you total liabilities. So you can take your liabilities away from your assets, and you're going to get how much the business was worth of 184,330. The amount we paid was 205,000, so the difference is known as your goodwill. So you're going to take your 205,000, take away 184,330, that gives you 20,670. That's your goodwill, and it goes in your balance sheet as a fixed asset.